Welcome to the Four Wise Monkeys, the best shares and investment advice on the web. Our four monkeys providing the wisdom this week are none other than David Stevenson from the Financial Times, Stephen Barber from Self-Trade, pro-share investor Paul Dolman-Darrell, and the naked trader Robbie Burns. And your host today is Ryan Dean. So, here we are, the first Four Wise Monkey show. Sitting behind me are three of our Four Wise Monkeys, and in a moment we'll be speaking to them about their trading ideas. But before all that, we go to Robbie Burns to find out what he's been buying and selling this week.
Yeah, Telecom Plus is the first company I'm looking at. Credit crunch is on. I'm looking for companies that have no debt. This has got £35 million in cash. Dividend 5%. It supplies electricity, gas, phone, broadband to people at very good prices. Doing very well, very successful, great management, and I think there's plenty of upside to come. Well, one I don't like at the moment, and one I'm shorting, is called Rightmove. You've probably heard of it, everybody has. But what it is, obviously, it's the biggest property website in the country. But what's the worst sector at the moment? It's property. We all know the next year is going to be bad. It's come down a lot already. The only reason it's staying up where it is management are buying back shares. I can't see that lasting forever. Once they stop that, there should be a lot more downside, and I'd be steering clear of this one.
Now, over to the boys in the studio to hear their trading ideas for this week. So, Paul, you're up first this week. What are you going to be talking about?
Carnival, they're a cruise company. They've got some really big brands. They are 50% market share, very low PE. Shares haven't gone anywhere for 10 years, but I see them really moving upwards as they start growing. Now,
David, you've got a view on this. Where do you stand?
Yeah, absolutely. Apart from being a great value stock, they're actually really interesting because they're effectively short on oil. Because I suspect both you and I think that by the end of the year, oil price is going to start going whoosh. Guess what happens to Carnival shares? They go up. So it's great all short.
Now, David, you're up next, and it's a bit of an odd one from you this week.
Mine is about yield, about a dividend which pays out about 10.5% a year, which I think is a pretty good idea in uncertain times. It's a very strange beast. It is Investec's perpetual preference shares. They're not enormously easy to get hold of, but they're basically, you get 10.5%, I think relatively low risk. I just think it's a great kind of safety thing in current markets at the moment.
Stephen, what are your thoughts on what David's saying?
Yeah, I think David's quite right to look for something as an alternative to cash, and particularly given what inflation's doing. And the sort of return he's getting on this is fabulous. It's not without risk. The company itself could go bust.
Yeah, Investec.
It is a perpetual bond, which means that it won't have an end redemption date. It has liquidity issues, and also it's listed offshore.
Channel Islands.
Yeah,
absolutely.
But
very mainstream, not.
But otherwise, it's an excellent return.
Stephen, you're up last this week, and I hope what you've got to offer is a little bit more normal than what David was suggesting.
It's not unusual. It's an asset class which is both important and something that's, I think, suitable for most portfolios, and that's infrastructure. It's all the roads, the railway, the communication, the hospitals, everything you like that needs building around the world. It's also an asset class which I think is inflation busting, which is very important in this economic climate. China's spending 10% of its GDP already on infrastructure. Predictions are that that's $20,000 billion are going to be spent on infrastructure over the next decade. And if you just look at the World Bank and World Bank reports, the amount of money that needs spending just to meet Millennium Development Goals is a huge amount. Where it has its advantages is that it has predictable, durable returns over the long term.
How do you access it?
You can access it through a number of ways, either directly in funds that invest in these projects internationally. You can buy an open-ended fund, and there's a number of those. Or in fact, probably the simplest way is an exchange-traded fund, a tracker which just tracks the index.
My shares have got one.
BGI, Macquarie has one, yes.
Paul, outside, I heard you, when you were discussing this, maybe yawning ever so slightly. But I mean, what are your views on this?
Yeah, well, I heard Russia were going to build all the major roads over the next 10 years and replace them all. But for me, it's a little bit boring. You know, it really depends on economic growth. It's not one for me personally.
Time for Fund Corner, where we put one of the most interesting funds out there under the spotlight. Every week and every month, it feels like there are new funds popping up. Sitting alongside me is Rob Davies, manager of the Munro Fund. Now, this is a very interesting proposition because it's quite young, but what makes it so unique?
Ryan, the fund is different because we use fundamental parameters to create the portfolio. We're not using opinions, we're not using market cap, we're using the fundamental parameters of the stocks. For example, HSBC is forecast to pay out £6 billion in dividends next year, And on our process, that means it's 8% of the portfolio. So it's a really thorough, clean process to calculate the fund.
Why are dividends so important here?
All historic data shows that reinvested dividends give you the bulk of returns. In fact, half the returns comes from putting dividends back into the market, let them grow, the beauty of compound interest.
Now, I noticed when I was having a look at the fund, you're quite heavy on banks, and surely that's quite worrying at the moment.
It is a worry. I'm sure there's more bad news to come from banks, but our data shows that banks offer good value, and again, historic data shows that value stocks do better than the market overall in the long term, and this fund is biased towards those stocks which offer value.
Well, Rob, it is a very, very interesting proposition, but I think we're going to have to wait and see, aren't we, on this one?
Well, I think so, but one thing that does go in our favour is we have low AMC fees of 0.75.
Hey, Rob, thanks for joining us. Thanks for watching the show. Remember to check out the website for more in-depth discussion from the boys about this week's pick. Myself and the monkeys will be back next week.